Hello, guys, and welcome back to the Cedi Investor. In today's episode, we have an update on the Cedi Farm portfolio. My main goal for the Cedi Farm portfolio was to outperform the Ghana Composite Index and any other benchmark. So, something like maybe treasury bills, bonds, any form of investments that I thought was performing quite well. My main goal with the Cedi Farm portfolio is to outperform that particular benchmark. And I started this particular portfolio, I think about 4 months ago, and I'm quite shocked that we have finally outperformed the Ghana Composite Index. You can see right here, we have the pink line, this particular pink line. This is the chart of the Cedi Farm portfolio since the start of this particular channel. And it started off around, yeah, the first week when I started this particular portfolio, I was down minus 6.35% and currently up 42.9%. In the same period, the Cedi Fund portfolio and that particular view that I started this particular portfolio was down minus 3% and it's currently up 33%. So I'm quite amazed. In just over 4 months, we've been able to outperform the Ghana Composite Index. I think I'm quite happy with that. But then the plan is to do it consistently because anyone can outperform the composite index once in a while. But what makes your portfolio a good portfolio is if you can consistently outperform the benchmarks such as treasury bills and inflation and also the Ghana Composite Index. So we'll go deeper into the Cedi Farm portfolio and I'll give you my thesis behind why I invested in all of these companies and my outlook on these companies going forward. And lastly, we are going to end off with a comment I saw on TikTok. It was quite interesting for me. I'm going to give my thoughts on it. Where someone was talking about how the operations of a business does not relate to the stock price. I think it was quite controversial. So we'll look at that as well. We have a lot to unpack today. Let's get into it. Starting off with the Cedi Farm portfolio, we can see the full breakdown here. I have the current prices of these companies and the prices I bought, the average price I bought these companies. Because remember, some of these companies I bought it at different prices. So we have the average price here, and you can see right now the portfolio return is 42.92%, and it's quite amazing to see such a return. You can also see the weighting here of all my positions. We start off with the biggest position in the Cedi Fund portfolio, and that's MTN. An average price of 3.1. This is very deceiving because I bought most of it around the 2.4, 2.5 level in the Cedi Farm portfolio. When you look at my main portfolio, I even bought some of them around the 1.9, 1.8 level, but in the Cedi Farm portfolio around the 2.8. But because I made one purchase around the 3.5 level, I think it brought the average price quite high. But all in all, around a 41% return, quite good. You have Enterprise Group around. I bought it, the average price around 2.87 in the Cedi Farm portfolio, current price around 3.5, and it makes up about 33% of the Cedi Farm portfolio. And now we have the biggest return, 82%. Farm Milk, currently trading at 7.5, but around the 4.1. Yeah, some around 4 CDs, some around the 4.1 level, and now its weight in the Cedi Farm portfolio is 21.8%, and about half of that, the weight of half of that is gains. So that's basically money I didn't invest but returns on that particular money. For better visualization, look at the chart here. We can see the returns. Farm Milk 82%, MCM 41, and Enterprise Group 18.47. So looking at this chart here, what was my reasoning for buying these particular companies? Why did I invest into Enterprise Group, Farm Milk, MTN? Let's take a look. You can see right here, the company is trading at 7.5 Ghana cedis. When you check months to date, we can see the company is up 60%. It started off the month Okay, this is not even starting of the month, around September 18th at 4.6, currently trading at 7.5. You can even see year to date as well, 102%, starting of the year at 3.7, and in the end of the year around 7.5. I started buying it around this particular level, the 4.1 in the City Fund portfolio. Looking at the entire business, I can summarize my whole investment thesis into three things: cost effectiveness, revenue, and margin improvements. And we can see right here the last one being efficient in terms of profitability and revenue generation. I can see, I can just take a look right here. You can see revenue. The company has been growing its revenue massively from 2020 to the last 12 months, which is trailing 12 months, 870 million. Even if you look at the margins of the business, you can see that the margins are improving. Basically, how much the business is able to retain from the top line is improving year on year on year. So after their revenue, if cost of sales is being taken out of the revenue, what is left for the business to use as operating cash flow is improving year on year. The same can be said after operating cash flow. The expenses that are taken out from it in terms of salaries, in terms of whatever form of expenditure that is taken out, the profit margin is also improving. And the same can be said for the cash flow margin as well. Let's take a look right here. You can see um, the in 2021 around 26%. That's for gross margin. 2022 21%, improved massively to 36% in 2024, about 34% in trailing 12 months. Hopefully they can, get back around the 36 level. But you can see how massively they've improved their gross margin. The same can be said for operating margin as well. It used to be negatives in 2021, 2022, massive around 9.8, used to be around 11% in 2024. So could be a little bit better, but they've improved upon it massively. The same in terms of the profit margin, now around 5.8%, whilst being negative in the past 2 to 3 years. Free cash flow as well, around 14%, massive. That's like another big point. Now they have a lot of cash on hand to improve upon their dividends, to invest into the business, to do share buyback. However, there are some key concerns about the business that I do want to address. Looking at even the revenue growth right here, we have the year-on-year revenue growth, how fast the business has been growing each year, and we can see trailing 12 months it's grown 54%. So compared to last year, the business has grown 54%. And the year before that, it grew 24%. But the thing is, when I look at the consumable space, and I think that's why maybe, regardless of how massive farm milk has grown in the CD farm portfolio, I still view it as the most risky investment in my CD farm portfolio. It's being a consumable product. In terms of Ghana, we can look at farm milk and we can say that farm milk has a strong brand loyalty. It is known everywhere. But when you look at consumable products, it faces a lot of competition. There's a lot of competition both in the space and outside the space of the consumable market. In the ice cream space, you can see that Fambo has a strong brand loyalty where probably it is one of the face names you are looking at when you're looking at ice cream in particular. But there's still so many other competitions in the ice cream space. Even when we expand from the ice cream sector in itself and looking at just consumables, there's a lot of products out there. Something like Calipo, something like Guinness malts, something like Bell Cooler, even what's it called, Kivo Gary or something like that. These are all consumables where it's so easy for a customer to say, "Oh, I'll go for this instead of Fano." You understand? I can if I have some nice buffaloes before they, you understand, and I want to pair it out with a drink. I can go for Famno, I can go for Calipo, I can go for Bell Cola, I can go for. There's like I hope I'm making sense. Like the competition in this business phase is huge. So looking at the revenue growth of 54% for this trading 12 months, very, very good, massive. But is it something I'm expecting the business to sustain over the next 5 to 10 to 20 year period? I don't really think so. And even if I look at the revenue growth, there's two forms of revenue growth. And unfortunately, in the statements of farm they don't really make that known to you as a shareholder or as an investor. You don't know if the revenue growth is from increasing demand. That means the volumes they are producing way more of farm milk products and people are buying it, or is it from increasing prices? That they are increasing the price of the products. Farm milk used to be 4 cedis, now it's 5 cedis, and now that is what is bringing that source of revenue. Because if it's from the latter, that's increasing prices, it's not really sustainable because it will reach a point where you increase price and that's to a point where I'm like, I can just go for the cheaper alternative if it's maybe Belcola or if it's Calipo or whatever. So I don't really think that the revenue growth at 54% is sustainable. I will be looking at around 24 to 25% for Cravo. So overall, I'm still quite bullish on FarmNob. I think it's a great company. But right now, I can't get over the PE ratio, for instance. A PE of 17.09. That's just quite a high valuation for this particular company. I think it's a massive 17.09. That's higher than MTN. It's higher than Total. It's higher than almost all. It's higher than all the banks. Higher than insurance company. I, in no particular universe, would want a company like Farmo where I wouldn't really see its earnings or its revenues is it's very predictable. Like I won't be able to predict how the consumable space for farm milk is going to be over the next 5 to 20 year period. Yeah, probably people will still consume it, but would it be at the same levels? That's a big question for investors or analysts to think about. So I wouldn't really say their revenue growth is very predictable and it's even going at a very fast rate. Probably when you move this year, every other year was around 20, 14, 25%. It's this year that they've gone massively to around 54%. Now, I'm not going to make any rash decision as to say I'm going to sell my stock at the moment. I'll be waiting for the quarterly report to see how the company is advancing. Probably they are even performing above my expectations and they could run such a high PE. But for now, I think the company is trading at a high valuation. Good company, going to grow, I think, over the next few years. But then for the valuation, is trading at a high valuation. I would want Farmlook to be traded at a PE ratio of about 8 to 10. I think that's a good PE for Farmlook. 17, that's just crazy for me. Up next, we have Enterprise Group here. And we can see the company is trading at 3.4. It's also up quite massively this year. We can see year to date, the company is up 71%, trading started the year at 1.98, currently at 3.4, P ratio of 2.8, and I think it's done massively well this year. However, this is still one company I'm quite very bullish on. I'm generally very bullish on the insurance space, but Enterprise Group for me is the company I'm most bullish on this particular company. Looking at my thesis for a company like Enterprise Group or even an insurance company in general, I think there are two main things you should be looking at. How good is the business when it comes to underwriting? And how good is the business when it comes to investments? Because essentially, that's the two main parts of the business you should be focusing on if you are looking at an insurance business: the underwriting part of the business and the investing part of the business. Because basically, an insurance company is underwriting policies for people. I don't know what they are called. I forgot. Is it like maybe policy holders or something? They have a name for it, but I've forgotten what that is called. But basically, you are writing some sort of insurance for a person where the person is protecting himself against whatever it could be: health, funeral policy, life, blah blah blah, motor, house, fire. The person is protecting himself against future risks. Should that risk happen, you are going to insure the person, pay that person some sum of money for protection against that particular risk. So one thing that the insurance company must do is to make sure they are writing good policies. And the second part of the business is the investment part of the business. Now that you are taking all those premiums, what are you using it for? Because if it's just there, essentially you are going to be running at a loss. You have to invest those premiums in places where you think you can get the most return. So essentially, insurance company do run a little bit similar to banks, but instead of deposits, they use premiums. And how banks use those premiums to invest into things like either loaning out to people or in securities. Insurance companies are also able to do the same thing or something similar. They are not allowed to give out loans to people, but they are allowed to invest those premiums into security. Looking at that two sides of enterprise business, we can see right here premiums income is going up massively. That's good to see. The total interest income, that is with the investment part, which I think they can improve massively. They are not really doing a great job in this particular space. But the main concern for me in enterprise group business is the reinsurance expense. Last quarter, that was the main reason I was quite upset with them. They did a lot of bad reinsurance. What the insurance claim they did with other insurance company, basically insuring their policies with other insurance companies was quite bad. So they ended up giving a lot more money to the insurance companies as to the amount of money they were able to get from those insurance companies. So hopefully that's one main thing. I'm hoping to see change or improve in the next quarter. But despite me seeing that as a bad thing, I think that's more of a short-term issue that can really be fixed, over the next few quarters. I don't really see that being a big issue over the next few years. It's really something marginal that, over 2 to 3 quarters they can really fix. So I'm looking forward to that. Another main issue for me when it comes to the insurance space is also competition among themselves. You can see, especially SIC, and I was very impressed with their latest quarter reports because you can see that they've grown massively. Well, if you still compare Enterprise to state insurance company, you can see that Enterprise is a much bigger company. But this year, SIC has been growing massively. Now, I do anticipate that it's because of a lot of governmental contracts being awarded to SIC. I can't prove that, but then I do think that's their main reason for that heavy growth. So I think that's another risks that you should be concerned with, especially if you're an enterprise group investor. But despite all these risks, I believe enterprise group has positioned itself quite well, especially in the insurance sector in Ghana. We know the penetration rate is still quite low. Literally, the penetration rate of insurance in Ghana is just 1%. Imagine how much the insurance companies are going to benefit if that should increase just by 2%, by 10, by 50%. So I believe they are going to benefit massively. And looking at even the PE ratio and the amount of free cash flow these companies have on hand, massive, massive, massive. So I'm very, very bullish on the enterprise group. Over the next 5 years, I believe investors are going to really enjoy in this particular company. Let's go to the next one. We end off with Scalcom PLC. This is another company I'm massively bullish on over the next 5 to 10 to 20 years. I strongly believe they are going to have a strong Q3 performance. So I'm waiting for their earnings reports. I can see every area of MTN's business growing, their data, their mobile money, even voice in itself. So that are my thoughts looking at the Cedi fan portfolio. So finally, we have this title comment here, and I think it's quite controversial. So I just want to give my thoughts on it. This was a comment on someone recommending GCB as a bank for investment. Now, this is what Senorita Lita said. Thank you, but sincerely, GCB has the poorest customer service. Please, they should do something about it. The workers and their attitude are like 5 and 6. Now, I don't know what that means. Like, what is the does it mean the workers and attitude are completely separate, or I probably need more clarity on that. But this was the reply I got here. So the person said, okay, but their stocks has nothing to do with their operations. And when I saw this first, I had to like think back, just glance at this thing for a few seconds to really see what I was looking here. I have to like I'm still marveled about this particular company. I would love to have a conversation with whoever this is, to have some sort of clarity as to why they are writing this particular thing. So if the operations of a business has no correlation with the stock price of the company, then what in fact are we investing for? Because are we just putting money into a company with no reason behind it? Someone says she is just a better person. What correlation does shares have with operation? Now, again, like I don't really understand what these comments are. Why are we investing into businesses? We are investing in the operations of a business. And based on that performance on the business, that is what translates into return for us as shareholders. Now, I do not agree with the comment here because I do think GCB has great customer service. I think it's one of the best banks with the best of services. But since it's one of the biggest banks in Ghana, definitely they have a lot of branches worldwide. You're not going to get the perfect of service in all the branches. You will definitely have this one or two people who are definitely bad ones. So I don't know her experience, but from my experience, GCB has great customer service. But in fact, if let's say what she's saying is true, GCB has bad customer service. What will happen to customers? I, as a customer, won't want to bank with GCB, especially looking at all the other alternatives in Ghana. We have Cow Bank, we have Access Bank, we have Eco Bank, Stanbic, and Fidelity. There's a lot of banks, Zenith, First Atlantic. There's a lot of banks in Ghana. So if GCB's workers are bad, especially in terms of attitude, in terms of their services, I'm getting slow connectivity. When I want to withdraw money, definitely can't get hope from them. Like everything the business is doing is quite bad. That will lead to customers moving on to other banks. That will lead to their deposits reducing. That will lead to GCB having less money to invest by either giving loans to people or investing in securities. And that is going to lead to their revenues going down. So, in fact, I don't see any other thing that will correlate with the stock price than the operations of the business. If the company is performing well, based on its operations, that translates into the fundamentals of the business, the key performance metrics. We will see revenue going up, we will see profits going up, we'll see dividends being paid, and that will in fact translate back into the shares of the company, into the stock price of the company. Over the short term, we can see prices of companies going up or down based on no particular reason. But over the long term, it is based on the performances of company that determines where the stock price shades at. Because if the company continues to perform, investors demand that particular stock more often. The investors price that into that particular stock or company, and we see the stock price going up. So, from these two people saying that the operations of a business, they don't see any correlation with the stock price. I totally disagree. In fact, the operations should be the only thing you are seeing some sort of correlation with the stock price. So thank you so much. Leave a like down below. Comment what you think about everything I've said. Do you agree with me or not? I really love to know. Thank you so much. And to meet again, have a wonderful and blessed rest of your day. Peace.